Hello, welcome everybody. This is Luke McCarty with McPherson Financial Group. I wanted to go over some portfolio trades and updates as of November 2021. Happy Thanksgiving to everybody. And let's jump in. So economic indicators. If you remember last month, we were all green, all positive. This month, the real personal income has turned negative. That is because of inflation. We're going to talk about inflation a couple slides from now. But when the prices of goods and services go up, our income, if it doesn't go up with it, right, is a negative. So if your income hasn't increased by 6% this year, you have less money. So your personal income is now negative based on last year. But everything else is looking good. Housing starts is good. Retail sales, unemployment, and industrial productions. One of the changes we recently made is we removed Johnson & Johnson from the stock model and added Thermo Fisher. Johnson & Johnson is splitting consumer health into a new company. All the growth will essentially be in the pharmaceutical and medical device side of things. So until that split actually takes place and we kind of see what the financials of the company look like, we decided it was time to remove Johnson & Johnson from the portfolio. We are replacing Johnson & Johnson with Thermo Fisher. If you look at a chart of Thermo Fisher, it is one of the best technical charts that's in an uptrend. It has a 22% return on equity versus industry average of 17%. And it has passed our proprietary screener for the last several months. So we've been looking at Thermo Fisher and had Johnson & Johnson on the watch list. When news came out of the split of Johnson & Johnson, the stock actually had a little pop, about 3 or 4% on that Friday. And so we gained that. But since just kind of hasn't been moving very much, I think, leading up to the split. And I mean, that it's going to take a while for them to actually split out. But, Thermo is just a better company at the moment and a better uptrend. So we made that change. We also removed PayPal and are adding in Tesla. So PayPal, along with Visa and MasterCard, are taking a hit, some of it from the COVID surge in Europe. There's a lot more, fear out there from a payment standpoint, under pressure from the eBay starting its own payment system. So PayPal has been in a downtrend recently. And even though we still like Venmo, and PayPal is now getting into the cryptocurrency side of things, it just feels like the market is losing a kind of respect for PayPal and also some of your payment processing companies that have had a really good run since COVID. So we're seeing that kind of rotation out of those payment companies at the moment. And we're adding in Tesla. So ARK Investments has a 3,000 price per share target by 2025. Some of this is coming from, right, the new Build Back Better Act has up to a 12,500 tax incentives for electric vehicles. And Tesla is the leader in this industry. Tesla owns, of course, the solar panels, Solar City. So they own, the solar side of things, of course, the vehicles. And so we like Tesla from a standpoint of the future push to electric vehicles. Tesla recently just had 100,000 cars, get ordered from Hertz. And it was interesting because Elon Musk made a comment that Hertz is not getting them at any discount. They are paying full price for every single car. So that's good for Tesla's outlook is, hey, even though you're buying a bunch, it doesn't matter. You're paying full price. So we think Tesla and Elon Musk has a lot of room left to run. And so we're adding that in place of PayPal. So still kind of on the tech side of things, still going to be very volatile, but we're looking at Tesla to potentially double, if not a little bit more, in the next 3 or 4 years. Inflation concerns. So this is a 12-month percentage change of the consumer price index. So it's all items, right? We didn't take anything out, right? So it's October of 2021 with 6.2% increase in inflation, higher than we were back in 2008, kind of before the big downturn. So we're seeing really high levels of inflation, right? The highest, the chart doesn't even show any higher, and it goes back to 2001. But with this being said, we're seeing a lot of things increase in price, right? Your gas, your groceries, your vehicles, your energy. I mean, homes, of course. A lot of things going up in inflation. This is a concern. If you're not keeping up with inflation, you're losing money. I don't believe the 6.2 is going to last, for multiple years, but it looks like it's still going up at the moment. So we're seeing a lot of inflation. And as the government continues to print money, right, some of that Build Back Better bill that's, getting passed at the moment or in process, right, it's printing up more trillions of dollars. So anytime we overspend, the government overprints, we see an inflationary environment. With that being said, right, what are some inflation solutions? Own stock of strong companies. So we have a proprietary screener that we run here, and we filter down our stocks, right? The thousands of stocks out there, we filter them down to 20 to 30, given the month or given the time we run the screener. Back in March of 2020, when COVID really hit, only 8 stocks passed our screener. So we're looking for strong companies with strong balance sheets, strong cash flows. Those are the companies that we own in our portfolios. You also want to avoid too much cash, right? You want some cash in the bank, right? 3 to 6 months. But other than that, you're losing money on that cash, right? CDs, losing proposition at 0.25%, 0.5%. A stable value fund in your 401k, right? Maybe earning 1 or 2%. The G fund is very common in the TSP for government employees. That's under 2%. If we go back to the chart, we just talked about, 6.2% inflation. Well, none of these cash CDs, stable value G fund are keeping up with inflation. So what we need to do is manage risk with bond alternatives. If you've listened to any prior videos we've had, we are negative on bonds. We think bonds for the next 3 to 5 years are going to be around 1%, if that. They're negative for this year. So we need to manage risk with bond alternatives. We're not recommending you just get out of all safe assets and buy stocks, because that may be too aggressive for you. But here's some, bond alternatives that we use. We use fixed indexed annuities that have a stock market component, but you can't lose money. So it has that downside protection from the insurance company, right? A buffered product has that downside protection of a certain level where maybe it's 15% or 20%. We have some of them in our portfolio right now with the JP Morgan hedged equity, right? That's a buffered product. Allianz has a buffered product of 20% buffer with all the upside of the S&P 500. So we need to use some of those where we get market-like growth with less risk than the market. Preferred stocks get that steady income stream. Some of the preferreds we're buying currently, are 5.5% to 6%, dividends, and the principal value does not fluctuate. So just be okay with making 5.5%, 6%, keeping up with inflation on something relatively safe. It's still a stock, but you have more creditor protection than the common stock. So a steady income stream with preferreds. Real estate, right? If you currently own a home or multiple homes, right, you've seen the value of your home price increase dramatically, especially here in the Brevard County area. But we want to own your, private home, public real estate. We have a new fund on the platform that we vetted and are starting to add to portfolios through Griffin Capital, where it's a mutual fund that owns, private and public real estate investments that have, really large minimums to get into. It's a kind of a fund of funds. Let me know if you have questions on that. We're getting ready to roll that out with a lot of these preferreds that we're using. It's kind of a bond alternative, pays about 5.25% dividend with growth appreciation. And then I bonds. So treasurydirect.gov, you can buy up to 10,000 per person per year. The current interest rate on those is 7.12%. Now, this fluctuates every 6 months, but currently it's 7.12%. You must hold for at least 12 months. If you sell after 12 months, you lose 3 months of interest. So not a big deal when you're getting 7. But it is technically a 30-year bond, but it has the liquidity because you're going directly through treasurydirect.gov. This is the only place you can buy it, and you are limited to 10K per person. So if you have cash sitting on the sidelines, it's a good place to look at. Buy for you, your spouse, even your kids. 7% is a phenomenal rate. It's not going to stay there. It's going to fluctuate, but if you can get 7% for the next year, and let's say it drops to 3 or 4 or 5, wherever it goes to, we'll get out and you've made, 6.5% on that 7%. So it's a good place to park some money. Of course, it's limited because it's, anything too good to be true from the government, they limit you. So I bonds are limited to 10,000 a person per year, must buy them direct through the government. All right, October 2021 performance. Wanted to hit on some of this. So this is our mutual fund and ETF portfolios. If you look at the top, our max growth is finally catching back up to the benchmark. Our balance 50, I still believe, is one of our best for this year risk-adjusted rate of returns. Right, it's making over almost 9%, and the benchmarks at close to 6, so well outperforming. That's due to some of our bond alternatives that are in there. And then conservative 30, right? Our steady Eddie, that's having another really good year at 5.3%. So keeping up with inflation for this year, of course, has outperformed inflation the past couple of years, but that's kind of a good barometer of, hey, I have some safe money. I'm okay with taking a little bit of fluctuation. Now, there's no guarantees on this that, you will make money, but look at the track record back to 2007. It's all positive if you held it for more than a year. So conservative 30 is doing well, more than a percentage over its benchmark. Multi-asset income is struggling, right? Only have about 0.5%, but the bond market is negative 1.6%. So 0.5% is not very good, but it's a lot better than negative 1.68. So multi-asset income is struggling from an overall, performance perspective, but we are well outperforming the benchmark. And the municipal income, about 1.89% with a 2.5% tax-free yield, as well outperforming its benchmark as well. The changes we made recently to Johnson & Johnson and PayPal happened in the stock model. So our stock model is now outperforming the aggressive benchmark. If you remember earlier in the year, we were lagging the benchmark. Now we are ahead. This benchmark includes international, small cap, mid cap, value, growth. It's kind of a blended approach. The enhanced dividend model is still currently our best performer for the year. It is 22 Dow companies with covered calls written on top, getting about a 5 to 7% yield. Equity income balanced. This is a 50-50 portfolio doing extremely well. It has a portion of the enhanced dividend internally in that model. And then 65 stock struggling still a little bit, but starting to rally back. And then 50 stock, almost 2% above its benchmark. All right, that is it for our November update. Once again, happy Thanksgiving. Give us a call, 321-253-2016 with any questions you have. Look at those I bonds, see how much money you have sitting in cash or in non-income or non-growth producing assets like CDs, the G fund, stable value, things like that, because we're not keeping up with inflation if we have too much money in those buckets. Thanks, guys. Look, talk to you soon.